IRMA stands for Income-Related Medicare Adjustment, I believe. Somewhere in there, I'm missing an A. There's two A's in IRMA. But,
I love that all of us know exactly what it stands for because it's so wonky. Neither of us care to know exactly what it stands for. We just know what it means, and we can help people with it.
Right.
But that's not how we define our success as being perfect with can we say what IRMA stands for. Hey, Nick.
Scott, what is going on?
Another day, another dollar, man. Good to see you.
Likewise. Looks like you're outside today, still soaking in that beautiful Southern California weather here in October. So,
as you're pointing out, like we are recording this in October. This will probably go live in October, November. It's a great time of year for people to be paying attention to what can they do to prepare for year end. So I figure we spend a little time on that today. Yeah.
Yeah, I like that. So often what's the saying as the burrs roll in, like October, November, December, the year's over, right? And so if we don't pay attention, especially in October, like we lose the year. And there's so many things, which we'll dive into today, that we can, if we pay attention to, really take note of and optimize our paychecks, our contributions. We don't miss things if we can, give ourselves that window in October to go through. And so a lot to dive into today.
Yeah. So we're going to go over 7 key things that we're thinking about looking at for you all as clients. And let's dive in. I think the first thing we would look at is required minimum distributions.
Yeah.
And making sure you don't forget them.
Mm-hmm. Mm-hmm. And for those new to that topic, right, required minimum distributions, if we have an IRA, we have a 401k, 403b, pre-tax retirement account that we've been saving, at some point, Uncle Sam, the IRS say, hey, we want our money. It is now time, whether you need the money or not, for you to start taking distributions and pay the tax bill that comes due with that. And so It is a sliding scale. Most clients, I believe now, depending on the year they were born, I think the RMD age is somewhere around 73. I remember 70 being the age for so long. And then I think if you're born in the 60s, it's now like 75. But there's definitely some strategies around when that money comes due. This is now taxable income that we have coming into, our tax return. And what do we do with it? Whether we need it or not, do we donate it and give it away?
Right.
And it's, and there's a couple things in the first year where you have an option where you could actually push it off to the next year. You do have to take 2 the following year. But
yes,
this goes to the theme of really this episode, which is if we're paying attention to our tax brackets, we can make that decision from a more informed standpoint when we're figuring out, hey, what bracket is this going to push me into? And is it better to do it this year or next year?
Yeah. So big picture, you want to be thinking about what's my total income going to be this year? What's my marginal bracket that I'm in? Does it make sense to delay this year or go into the next year? If you've already taken a required minimum distribution, you have to do it no matter what. Mm-hmm. We often see that a lot of folks, it makes sense when markets rise to take it toward the end of the year so that as the income grows, you get to take those funds out. There's more of it left over. That can make a lot of sense. Sometimes you do forget to take it your first year. You get up until the tax filing deadline, until April 15th to go ahead and make that first distribution because you might have forgotten. And accountants are usually good at helping you remember with their tax software. Yeah. And then you can see whether or not you want to take it year over year. But yeah, to your point, go and do that. QCDs are this thing called qualified charitable distributions. All that means is you don't have to give money to yourself out of the required minimum distribution. You can give it directly to charity. But you can't give it to like a donor advised fund or something like that. You can only give it directly to the United Way, the Red Cross, whoever you want to give to your church.
Now, what's nice about that is that you get credit for 2 things, making your RMD, and then you don't get hit with that income, if I understand correctly, as well, which is really nice.
Yes, you do understand that correctly. That is correct.
There we go. Doesn't come up all that often.
Next thing, no. The next thing you may want to look at is if you're in the years between when you're retired and when you have to take required minimum distributions, maybe you're delaying Social Security as well. Roth conversions can make a lot of sense in those years. We have previous episodes on that. Mm-hmm. With the new extra deduction. You'll remember the exact words of what it is. There's a new deduction where every person over 65 gets $6,000 more deduction for the next 5 years. So if you're a couple, you could take an extra $12,000 of Roth conversion, and it really doesn't do anything compared to your previous year's tax return.
That's right. It's the enhanced senior deduction. And there are some income phases, or phase outs rather. I think it's maybe north of 100, 150,000, somewhere in there. But to your point, married filing jointly, you're picking up $6,000 each. That's $12,000. And so now that we have that deduction, why wouldn't we just slide over an extra 12 grand into from our IRA, 401k to our Roth? And guess what? We're back in the exact same situation that we were before we had the Roth conversion, which is really nice. And so
exactly,
I call it the golden window. There's a lot of phrases for it, but kind of the sweet spot of retirement is from the time you no longer have income coming in until maybe Social Security or what we just mentioned, required minimum distributions. But it's this window where we now have gone from our working tax bracket, 22, 24 or higher, to now 10. And it gives us this opportunity, if we pause for a moment, to see what bracket we're going to fall in that given year, to say, I could choose to now pay taxes intentionally at a much lower rate and move some money from my IRA to my Roth. Because maybe when we get into our 70s and we have these required minimum distributions and we have Social Security, we're going to be in a higher tax bracket. We still have to take that money out. So having some proactive planning really goes a long way to take advantages of those lower brackets.
Absolutely. And to that point, if we go to another place that you could do this with, if you have a taxable account, you can do the same thing with what's called tax gain harvesting. And so you'd want to go look at, well, what do I owe in long-term capital gains at the levels that I'm out of income? And you might find that you could do a Roth conversion, you might also find that you could potentially do some tax gain harvesting in your taxable portfolio. If you have a lot of income right now, on the other hand, and you don't get a lot of tax gain harvesting, you may want to also look at, is there any tax loss harvesting we can do inside the portfolio? And that's where we simply choose to sell something, lock in the loss, own something similar for 30 days, and then either continue to own that after 30 days or buy back into the old position. And that basically creates these losses that we can utilize for future gains when we need to take money out in the future. Or maybe we know that like Nick's going to retire from, Southern California to Hawaii. So he's going to sell his home in the future. Well, if we can create a lot of losses in the portfolio while we still get the return of the markets, well, now we can utilize those losses to offset the sale of the home in the future. So there's lots of things we can be doing with tax gain and tax loss harvesting to help out a financial plan.
Yeah. And, this reminds me of a client situation I had recently had where we just don't know until we know. It's like we need to look at what tax bracket we're going to fall in and, call these gems, hidden nuggets, gold mine, whatever you want to, assign the analogy to. But, we had clients that, especially with the run up in the market, they've done a really good job investing, staying invested through the craziness and the turmoil. And now we're looking here in October and we have gains within their brokerage account. Well, they're retired, Scott. They have no taxable income. They're delaying Social Security. And we know, because they've also done a great job saving over the years, that they also have flexibility in their accounts. So they have a Roth, they have a 401k, an IRA, and a brokerage. And we're figuring out, hey, where do we take our first dollar from in retirement? And one of the conversations we had when it comes to this topic of tax gain harvesting and bracket filling was, we have all this extra, and whether you need the money or not, we could take advantage. And, I think a lot of people realize, well, capital gains, they're more favorable generally than ordinary income. Most people just say it's taxed at 15%, but there's this hidden nugget where if your taxable income's low enough, and it's somewhere around under 50,000 if you're single and just a shade under 100,000 if you're married, that's taxable income, your capital gain rate is 0. Mm-hmm. And so that's what we're getting at here is, even if you don't need the money, could we trigger a sale and a gain, have it realized at a 0% rate, and then that just becomes our new basis for that portion that we could then use in a year where maybe we need the money but don't want to trigger gains. So Really powerful stuff that, if we don't take the time to look where we're at, we miss it. And then we can't go back once the calendar turns to the new year.
Absolutely. Totally agree with that.
Yeah.
And that kind of, the next thing that kind of leads into is going to be, because we're still looking at, like, you thinking of your own income and your own tax return and where you're going to land. Another thing that would immediately jump out based on the changes that happened with the one big beautiful bill and where we're at with giving. We kind of mentioned QCDs a second ago, qualified charitable donations from IRA accounts for over age 70. But another thing we want to look at is just charitable giving and what are we doing around that? So one of the things we want to look at for clients is, well, are you itemizing your deduction still, or are you taking a standard deduction? And if you're taking an itemized deduction, giving to charities any year can make a lot of sense.
Right.
But if you're giving to a standard deduction and we want to be giving in big ways, we might want to look at having something like a donor advised fund. So, and I'm sure you can chime more on what that is. And if that's the case, we probably want to fund it with this idea of bunching. So like, if I know that Nick wants to give $5,000 a year to charities and he's on a standard deduction, well, he's not going to be able to get a bang for his buck for that donation. But if instead we give 10 years of giving in 1 year, now we're up to $50,000 of giving. So we make it over the threshold of the standard deduction. We get the tax benefit. And now that we've done that, we now have 10 years of giving in a donor advised fund.
Yeah, it's a powerful strategy. I love the idea too of like being able to look at, okay, if we're not at the threshold where it makes sense to do itemizing, but we're still charitably inclined, what does that look like if we're going to do the contribution to that 501c3 or wherever that year anyway? And this is something we consistently do. Is there a way to supercharge that? And so this idea of putting them together into multiple years, especially, if it's, someone doesn't have the funds maybe to do 10 years, what they could do, maybe they have the funds to do 2 years and they give in December and they give in January, just batch it December and there you go. And so, yeah, whether it's that, a donor advised fund, and I love that idea. It's like, how do we get the most deduction today? And the nice thing about the donor advised fund is you don't have to make that decision on where those proceeds go immediately. We could choose to dole it out year after year. We could actually choose different charities, 501c3s, churches.
Yep.
They could be different. And then,
Absolutely.
In the same way too, outside of a donor advised fund, if we have, especially with a run up in the market, funds that have appreciated that you're like, I don't know what to do with this. This is a ticking time bomb with our taxes. Maybe you got into some of these really, growth stocks, like Palantir, Nvidia, and your basis is really low. Donations, they accomplish the same thing.
Absolutely. So yeah, you can donate that to a donor advised fund. You can donate it direct, as you're saying. And then obviously the tax benefit of that for you guys at home of giving, instead of just stroking a check for cash where, Nick earned an income and he has $1,000 of cash he already paid taxes on that $1,000 to now have the $1,000 to give from his workers, from the work that he did. But if he has $1,000 of, Google and his stock cost basis and it's 10, when he gives the $1,000, he just gave $1,000 again. He just didn't have to pay the long-term capital gain on the $990. So that's why it's beneficial to give appreciated stocks whenever we can. Another thing I would just add to that, if you're looking at bunching or if you are interested in bunching, is that there's a new floor that's getting established next year for charitable giving of 0.5% of your adjusted gross income. So if Nick makes $100,000, 0.5% of that's going to be $5,000. So he doesn't get to account giving on his tax return now until it's above $5,000. That starts in 2026. In 2025, that doesn't exist. So if you do want to do something like a bunching strategy or something like that, doing it this year makes a lot of sense.
Yeah, that's what I'm hearing. This is the final year to really get a little more bang for your buck.
Yeah, and it'll still make sense to give, right?
Right.
You just won't get as much bang for your buck on the tax return.
Yeah. And as we look at those limits and talk capital gains and what have you, my mind also goes to Medicare and health insurance for early retirees, because being able to stay in a certain bracket from a Medicare, we call that, and we'll get into IRMA in just a minute, but understanding where we're going to fall in this current year, helps shape the landscape of premiums going forward.
Yeah, and you can remind me what IRMA means because I always forget. But for you people at home, essentially the Medicare premiums, A and D, are set off of what your tax return was 2 years ago. And so as you set certain thresholds, that premium changes.
Mm-hmm. And if you go above that threshold, it's pretty strict. Even $1 over, you're in the next bracket for an entire year. IRMA stands for Income-Related Medicare Adjustment, I believe. Somewhere in there, I'm missing an A. There's 2 A's in IRMA.
I love that all of us know exactly what it stands for because it's so wonky. Neither of us care to know exactly what it stands for. We just know what it means, and we can help people with it. Right. But that's not how we define our success as being perfect with can we say what IRMA stands for.
But the concept holds, right? Where we want to look at where our income's going to be and can we stay below those thresholds? Because the idea behind the concept is, given that it's a government program, if our income is higher, the government's going to say you can afford to pay more in your health insurance premium. And traditionally, It's taken then out of your Social Security, or if you're not receiving Social Security, you write a check for it. But those bands, depending on where your income fall, could be pretty expensive. I think that the last one, it's like $600 a month just for Part B alone. Whereas the first one, I think it's either $0 or $185, something like that. So being able to plan around, hey, are we going to do a Roth conversion? Oh, I need more money, and it's going to trigger capital gains. Oof. Okay. 2 years from now, it's going to really come back to bite us, though, when it comes to this IRMA and our Medicare premiums. And, we talked about it earlier, Scott, there's still a lot of questions for our early retirees on ACA premiums and where they're going to fall for the years ahead. Because for so long, we were able to plan to say, hey, client example, Joe and Jane, if we can keep your income low, we're going to qualify for the Affordable Care Act premium subsidies. And we could do that by taking money from cash or a brokerage. And so we'd have that conversation. That is, that's up in the air right now. We probably won't know those numbers till maybe end of November at the earliest. They do have to publish them by November 3rd, I believe, but there's a continued shutdown. We're probably going into
there's a government shutdown, and that's the debate right now is the government shut. Well, there's no debate, but that's the standoff is on these subsidies. So yeah. We shall see.
We shall
see.
Yeah.
The one that jumps to me immediately when I think about people wanting to save and reduce taxes that they're going to owe when we're looking at year end, now is the time to go look at your pay stubs and see how much have I saved to my 401k. Have I done my catch up contributions if I'm over the age of 50, right? So numbers this year were 23,000 max for 401k, 7,000 for catch up, unless it's 60 to 63, if I remember correctly.
60 to 63.
And then it's 11.5, which is just random. But so there are things to do there. If you're a small business owner, do you have a SEP IRA so you can put away 20% of your gross income, or 25% if you're an S corp? If solo 401k is even better in that circumstance, right? So like these are the things you want to have taken care of before year end. A solo 401k has to be open before December 31st to fund for the tax year. Those are all things to be mindful of.
Yeah. And what I'm hearing is looking at how much room do we have to go? Because, here we are in December, holidays are around the corner. And, if whether it's through open enrollment or maybe you did it in January, chances are your 401k election, how much you're saving, it's on autopilot. And so now's a good time just to lift our heads up, just to say, hey, is there still, with time left in the year, an opportunity to increase our contributions to fully get that tax deduction, to max it out?
Yes.
Same thing goes, we've talked earlier about health savings account, same benefit as well. We love that account, turns into, a glorified retirement account later on down the road, but we can pick up that deduction if we can max it out. And so, when we walk our clients, Scott, around September, October through tax planning, not only are we talking about so many of these topics, but we're taking the opportunity to look at how much they've withheld this year and whether or not they're on track to, either net out or get a refund, or in a lot of cases, if they've under withheld, this is an opportunity to say, ooh, we need to actually adjust these final paychecks heading into the end of the year.
100%, especially for people who have like bonus bonuses coming,
Yeah.
and stock compensation. It's something that very commonly happens that we under withheld. So just knowing what's your safe harbor amount, be that 90% of your income or 110% of your income. For most people that we work with, it's 110% of what you paid the previous year to be safe and not owe penalties and interest above and beyond what you need to pay in. But you probably need to set aside more. So just knowing what that is, absolutely, that's important to know. And then for the 401ks, if you do go in and you're like, oh, you know what, I do have the cash flow to max out that 23K or that 30 grand, and you're going to go do it you're going to ratchet up the percentage to be okay this year, you're going to get used to that. So when you get into January, go dial it back to whatever the new amount is for 31 grand for the year. I'm just making it up that 30 goes to 31. Whatever that is, make it so it's that percentage then for the rest of the year, and you're fine. Now you're just saving more, but do it as a percentage, not a dollar amount. When you do it as a percentage, you don't have to change it as often.
Yeah, that's really good. And I mean, same thing goes for taxes. If you find, oops, it's October, I've under withheld for the year, remember that for next year when you go into January, even over withholding just a bit so that you're in a more favorable situation in the years to come.
I know before we for started today, you were chatting about something that happened with a client of yours with Social Security.
Oh, yeah. This one was a little more nuanced, but, for our listeners, Social Security does have a provision. It's our spousal provision where if there's a stay-at-home spouse or that spouse has maybe less working income than the other spouse, the spouse gets the option when they are retired and they go to elect Social Security, that they get the higher of two choices. One is either their full benefit or 50% of the working spouses or the higher income earner, which is great. Now, sometimes when a divorce occurs, you forget about that benefit and you just focus on yours, and you're kind of running that race. And, in this particular case, my client had been married previously, and this was probably 20, 30 years ago, and they were married longer than the provision, which is 10 years to qualify for this. And sadly, her ex-husband several years ago passed away. And this came up over the topic of our conversation. And as we were looking at retirement planning, I said, well, hold on. How long ago did that happen? Okay, a couple years ago. How long were you married? 11 years. Interesting. Okay, you qualify for this. Have you started taking your own benefit? No, I haven't. Okay, well, how old are you? I'm in my 60s. And so we started just to trace things back, and we ended up calling Social Security. And what we found out was they were eligible for their late ex-spouse's survivor benefit. And here's the kicker, is they were able to start claiming it at 62, 63. I believe it's over the age of 60. It has a little different rules than a normal Social Security. And the best part was they were able to claim that for the next 6 to 7 years while they deferred and delayed their own benefit until 70. And their benefit during that entire time continued to grow and grow.
Yeah. Great reminder that oftentimes we get trapped in thinking what we have and we don't think the big picture all the way through. That's one of the joys of getting to work with clients. So I'm glad you brought it up today.
Yeah.
Because it is just who might it affect? Probably not a ton of people, but more people than you think don't realize that you need to pay attention to your ex-spouse's benefit and that you might be able to claim that as well.
Yeah. I mean, there's a whole thing in there too of just trying to figure out okay, well, how much can you earn during that time if you want to collect benefits concurrently? And, it's just, we tell ourselves stories, or clients do too. Like we all do. No, that doesn't apply to me, or I don't think so. I heard somewhere and, never thought to brought it up. And I said, oh, hold on, let's lean into this a bit. Let's explore it. If I'm wrong, that's okay, but let's just make the phone call.
Totally. Yeah. And that we can get geeky on that another episode for sure. Cause there is the whole thing. If you're still working before your full retirement age, there's a big clawback that occurs. If I remember, it's a huge 90% or 85% or something. It's most of it comes back. So yeah, different chat for a different day. But hopefully these are helpful tips for you for things to think about as you're coming into year end, as you're planning for your year.
Yeah, a lot of value you could add there. So take the time, dust out the pay stubs, see where you're at, figure out your 401k, and find some extra value.
All right. Well, until next time.
All right. See you later, Scott.
Thanks, man.